Q1 earnings press conference of TCS. It's a pleasure to have you joining us. So we have a few of our friends from the media in person, and I want to thank everyone for braving the rains and being here. And we have some of our friends joining in virtually as well. I'll quickly introduce the management. We have Rajesh Gopinathan, MD and CEO.
Hello, everyone.
NGS, COO.
Good evening.
And Samir Seksaria, CFO. Milind, our CHRO, could not be here. Milind Lakkar had a bereavement in the family, so he isn't able to be here, but he sends his regards to everybody. We're going to start, as always, with the CEO address. Rajesh, the floor is yours.
Thank you, Kritika. Good evening once again, everyone, and welcome to TCS's first quarter results. We started the year on a strong note, continuing the growth momentum that we enjoyed from last year. We've been steadily seeing progress across both markets and our customer bands, and we have had a revenue growth of 15.5% on constant currency year-on-year basis, giving us a revenue of 52,750 crores or about $6.78 billion. This growth has been, as I said, broad-based across geographies and markets. I'll get into that in a while. From an operating margin perspective, this is the quarter where we do our annual wage increases and promotions, and the total impact of that on our P&L is about 150 basis points. Adjusting for that and other seasonality, we are at about 23.1% on operating profit level, giving us an operating profit of 12,186 crores in reported rupee terms. That flows through to our net profit also, with net profit coming in at slightly below 9,500 crores and a net margin of 18%. Our cash conversion continues to be very strong. We have about 114% as net cash from operations to net profit conversion, and bringing us total cash earned in this quarter of 10,800 crores and a cash balance of slightly above 52,000 crores. Our steady growth on revenue is reflected in growth across all our customer bands. We have had steady additions across customers in all revenue bands. At the top end, our 100 million plus customer base grew by 9 on a year-on-year basis, going to 59 clients for this quarter. We have been sharing with you our continuing investments in our IP development, and that initiative continues at pace. Our total patent filings stands now at slightly above 6,750 patents filed, which is up 760 on a year-on-year basis. In terms of actual patents granted, we are now at 2,400 patents, which is up 429 patents on a year-on-year basis. This continues to be a key focus for us, not just from our products and platforms perspective, but also reflecting the kind of intellectual strength that the company has in both across its solutions and various other product and other research areas. In terms of employee addition, in this quarter we have come to a net employee count of 606,000 employees, 606,300 employees, which is up 97,270 on a year-on-year basis, or a growth of 19.7%. We continue to add employees to build up the capacity for our long-term growth and balancing our demand as well as what we see as continuing demand for talent, which is reflected in our attrition numbers also. Coming to segmental performance, our largest geographical market, North America, grew at 19.1% on a year-on-year basis, continuing the very strong growth that it has been experiencing over the last many quarters. We are now at $3.6 billion on a quarter basis in North America. Both UK and continental Europe grew slightly about 12% on a year-on-year basis, respectively both of them coming in at slightly above $1 billion each for this Q1 quarter. From a vertical market perspective, again our largest segment BFSI continues its growth momentum with a 13.9% year-on-year growth, clocking in at $2.18 billion of quarterly revenue. Retail and CPG, which bore pretty much the brunt of the pandemic, has been recovering very well, and the recovery continues with a 25% year-on-year growth, clocking $1.08 billion in revenue. Manufacturing, which has been slightly volatile, but is still showing strong continuing growth momentum at 16.4% on constant currency terms at $670 million for the quarter. So overall, this has been a quarter of strong performance, strong steady performance, continuing our journey from last year and the last few quarters. As we look into our client universe and the client discussions that we are having, we see steady demand as reflected in our pipeline and deal closures. We had total contract signings of $8.2 billion this quarter, which has a couple of deals in the range of about 400 million plus. Otherwise, a very good mix of deals across all sizes. This is up about on a year-on-year basis also, it is slightly up compared to 8.1 billion in the last year. Continuing client conversations also indicate that demand for technology is very robust, and the demand drivers are very similar to the key themes that we have been talking about in the past, primarily driven by the cloud transition, as well as investments in customer experience and other operating model transformation initiatives, both on the growth and transformation side as well as on the cost and optimization side. So overall, a steady quarter, continuing and consolidating our growth journey and validating many of the strategic calls that we have taken in terms of sources of demand as well as our approach to the markets. With that, I'll turn it back to Kritika, and we'll be happy to take some questions from all of you later.
Thank you, Rajesh. So our first questions set is going to be from all the journalists who are physical. We are going to take the questions from the journalists that are joining online. After that, we have a huge list, and of course, we have a time constraint. So a sincere request to everyone to keep it to 2 questions. And if you're not able to come to you, we'll try to address your questions separately. First question from Sajid Mangat from Quint. Sajid?
Thanks, Rajesh. Sajid here from BQ Prime. My first question is with respect to the pipeline and the outlook that you see, especially now that you have this murmurs of recession and slowdown coming in North America and European markets. How do you see this pipeline and demand scenario going forward? On the issue of attrition, since Milind is not there, if you can address that, 19.7, you had indicated that there may be a quarter or two of increase, and then you're going to see a LTM falling down. Do you still hold by that attrition rate, attrition outlook that you had going forward? And Samir, on the margin side, 23.1%, where is the pain coming in from? Is it only the salaries that's there, or is it subcontracting which you are not able to convert or reduce much? And what is the scenario with respect to supply side constraints which you are facing?
Thanks, Sajid. On the demand side, and in fact, all your 3 questions are interrelated. On the demand side, we are seeing steady demand from our immediate conversations with customers, or the short term to medium term. So all projects that are currently going on, the pipeline conversions, all of that indicates a very steady demand environment. As you asked, we are also constantly polling to see whether there are any early indications of softening, and as of now there is nothing. Into the middle of the year, we've been very close to our customers, and they seem to be very focused, and no indication immediately available. However, senior level discussions, there is a increasing discussion about the recession, no different than what you and me are also reading in the newspapers, but we don't see an immediate footprint of it on our demand side. The pipeline perspective also, the pipeline build is quite strong. and the nature of deals are also remaining fairly strong. And we are running at about 1.2 times book to bill, which is above our long-term average. So immediate basis, the demand continues to be very strong. On the attrition side, the attrition on an LTM basis, as we said, it's about 19.5%. The attrition in this quarter should be also considered from a seasonality perspective. Typically, there is a amount of our junior population leaves for higher studies or other areas during this period of time. So there is a bit of seasonality into this quarter. Having said that, attrition is still not yet flattened or started to dip. So it is not just the LTM one. On an absolute basis, it is continuing to increase, though on a percentage basis, it is starting to flatten. And we expect that that might continue into part of this Q2 also. And it will be H2 when we will start seeing some amount of more meaningful moderation of it. So that's our immediate short-term view on the attrition. But from a medium to long term, we think that both the supply side as well as the demand side is easing up in terms of talent coming from outside of the immediate industry system, and that should play into moderation of the attrition side. I will, since it is interlinked to this, I will take the other one also. What you're seeing on the employee cost side, over and above the typical salary hike, which accounts for about 150 odd basis points, is a reflection of what's going on the supply side and attrition side. So that will continue to play out. We are quite focused on staying very competitive in the market and making sure that we chase the demand where it is, and making those investments to make sure that we capture the demand. The opportunity to optimize will come when some of these other parameters start to stabilize.
If somebody can add something on the cross currency part of it as well.
So during the quarter, there was significant cross currency variations because dollar strengthened against most of the currencies. And I think you are asking on the margins, what's the impact? We had a 25 basis point positive impact on the margins. If you look at it from a revenue perspective, we had about 220 basis points on the dollar and approximately 80 basis points benefit on the INR side on revenues sequentially.
Thank you. Reema Tendulkar from CNBC TV 18.
Gentlemen, it's great to see you in person. Rajesh, how would you characterize the demand FY24 onwards? That's what the street is worried about. They believe FY23 is going to be strong for the industry, but they're worried that FY24 onwards, growth could slow down. How would you address that demand? And NGS, deal wins have been strong. The pipeline is looking good. But can you talk a bit about the decision-making cycles? Any signs of that slowing down or deal conversion taking longer? And also the nature of the deals. Are you seeing signs that discretionary deals or discretionary tech spend is perhaps going to come under pressure based on your initial conversations? And Samir, on margins, at 23.1%, this is the lowest in the last many quarters. The rupee has started appreciating. Pricing, you all have already taken some pricing at individual client level. At what point will it start reflecting? Could you give us a sense of the margin outlook? And one question filling in for Milind on hiring. Hiring at 14,000 is also much lower than the last few quarter average. Is it just a moderation of the record hiring that you did last year? Or can we read it as a lead indicator of perhaps demand is slowing down, which is why you're hiring less?
Reema, as I said, our response to the persistent news flow in the market is to stay close to our customers and continuously poll them to get a better sense of where that is going. And that does not indicate any immediate impact. But the discussions, obviously, in those organizations are also on. So it's very difficult for us to today take a call on what is likely to be FY24. So our approach to it is to position ourselves to be able to effectively move in either direction, irrespective of what the demand scenario is. You referred to our record hiring last year. We have built up a significant capacity, not just at the mid-level, but at the entry level also, where we did very large entry-level hiring. And our hiring program continues at pace, but with its seasonality. Typically, Q1 is the softer quarter for our fresher inflow. Q2 and Q3 are the higher quarters for fresher inflow. So we are, from a capacity perspective, we are well positioned to move. From immediate responsiveness perspective, we are continuing to stay very focused to make sure that we pick up the capacity required in local markets to deal with the immediate demand that we see. And that will position us for both continuing demand, or if there was a demand moderation, we have enough flex available in the structure to be able to moderate ourselves if the demand were to fall off. So given the current scenario, that's our approach to it, to position ourselves to be able to move swiftly in either direction.
So is that why you've not hired very aggressively?
No, actually our EP hiring continues at pretty much the same site. The trainee hiring, as I said, is more a period to period difference. That's the only, it is in terms of which period you bring that in. And it's a reflection of the fact that we had very high trainee inflow into the last 2 quarters. So the system has enough to digest through that.
NTS on deal conversions and decision-making?
Yeah. First of all, it's great to see all of you in person, right? And it's so nice to be back in a world where we could host customers in our facilities, okay? Almost, the last 4 or 5 weeks, we've had a umpteen number of customers visiting our facilities, and it was very nice interacting with all of them, okay? From our client interactions, as Rajesh articulated, we don't see any, let's say, a slowdown in demand, or they are reprioritizing their projects or putting budgets from one bucket to the other. We don't see any of that happening, right? And we have, for some of those customers, we've explicitly asked those questions, and based on the inputs that we have got, and I think we are reasonably comfortable that at least in the near term for this financial year, I don't think that they are looking at doing any of these things right now, right? Are they worried about the macroeconomic trends, etc.? We all look into that. They also look into it, but we don't see any negative inputs coming from anybody, right? On the other hand, most of them have said that, look, we have got thousands of positions open, right? I mean, that's the kind of feedback that we're getting. And as we always have done, whatever we hear from the customers, whatever we see in the market is what we go and tell you, right? So internally, we are also organizing ourselves to be executing programs, and that we win, and then we contract, and then we've done a fantastic execution during this quarter as well. As far as the deal conversion cycle is concerned, it's pretty normal. We don't see anything abnormal, and whether it is a large deal or the growth and transformation kind of projects or typical outsourcing deals, we don't see any anomalies, right? The way that we have converted the deals, the way that we have contracted this quarter, 8.1 billion, North America with about 4.6 billion, BFSI contributing to about 2.6 billion, all of that, it went through the same pace that we are typically used to, and I don't see any challenges there. Execution is important in that context, as Rajesh said, that look, we have hired a lot more laterals that are required for this quarter than typically we do. And given that, we would like to send our people back to, let's say, United States or other countries, but then the visa processing and the work permit processing time, there is a lead, and which essentially means that we also have to employ a lot more subcontractors and business associates as well, which are because we need to ultimately execute it, and these are all opportunities for us to optimize as we move forward in this financial year.
On your question on outlook on margins, so typically in Q1 we have an impact on margins since we give a full cycle increment, which is across the board. It's not split across quarters, and what we do is we claw back on the margins through the period. and we'd rely on pyramid utilization as well as growth as levers to get back to the previous year margins, and that's what we'd focus on. And over and above that, we are focused on getting to our comfort band or closer to the comfort band, and towards that we'll look at realization and pricing as one of the key levers. As I've called out, currency support would be another expectation, and lastly looking at operational efficiencies like subcontractor cost optimizations, etc., being the third lever.
How much can pricing and realization improvement contribute to margins?
We'll have to see. So right now, if we look at, we are seeing pricing improvement on a case-by-case basis, and if you look at our realization this quarter would have a negative thing, because we have, as you called out on the hiring part, we have proactively and strategically built up capacity through the last few quarters. That reflects on the realization numbers, but we are focused on looking at levers to optimize on those.
Thank you. Anisha Jain from ET Now.
Good evening, gentlemen. Hi, this is Anisha from ET Now. And I'll ask the question one by one for convenience. Rajesh, first to you, 26 to 28% margin band is the target range, and we are moving slightly away from that. Is it a reasonable expectation that it's likely to happen only after FY24 now, and at least not over the next 12 to 18 months?
FY24 is too far away, but our immediate target would be to get to 25 and then onwards. The way to think about it is, as we have said, it is not a target that we set. It is what we are working on internally, right? And the best way to think about it is that we are guided by profitable growth, and we are guided by that as our goal. And we are focused on, as Samir said, to recover from where we are currently and to continuously build upon it. And we think that structurally, even the current attrition that we see is a transient phenomena because of the demand spike that happened last year. And as the supply and demand balances out as we go forward, we will be in a more stable operating environment, which will allow us to get back to the margin bands that we believe structurally is possible. So no change to our overall approach to profitability, but we are tactically staying agile to make sure that we are capturing the demand and positioning ourselves, and then we will optimize as some of these other pressures start easing off.
So let me put it slightly differently. This time around, there was a 150 basis point impact on account of the employee wage revision, which is not likely to happen in the coming quarter. So from here on, should we expect the margins to improve at least on a sequential basis?
Absolutely. That's our model. We
Sure.
take the first quarter, we take the wage hike, and then we improve.
So 23.1 is bottom per se, at least for the margins.
At least that's our target.
Sure enough. And just coming to you, there has been a tad bit of disappointment when it comes to the deal pipeline, and you guys have spoiled us because last time the number was $11 billion. But reasonably, over the coming quarters, should we expect the number to lower to the range of 7 to 9, or will it continue to be in the 8 to 10 band?
And I think we have been, if you look at it, what we did as a deal value, total contract value over the period of several quarters, we were in that 5 to 7 range, and then we moved to 6 to 8 range, and then the expectation now is to be at the between, let's say, 8 to 10 range, right? But 8 to 10 range is a bit high in the sense that, look, the 11 billion is marked by 2 large deals, right? So I think it's safe to assume that will be in the 7 to 9 billion range.
So 7 to 9 billion, and what are you seeing in terms of the deal win pipeline, large deals versus small deals? Any color there?
This quarter, we had 8.2 billion overall, and in that, as Rajesh said, about two $400 million kind of deals, which are the largest deals that we had. Otherwise, it was all a combination of small and medium-sized deals overall. I think that trend is likely to continue, as we have always maintained that the large deals, which typically people say that's a billion plus kind of a deals, is one-off, and if you are able to get 1 or 2 deals in a year, that would be really Christmas. Yeah.
Okay, fair enough. Samir, coming to you, you mentioned that pricing has been going higher and realizations have been going higher on a selective basis, but is there any trend in terms of geographies if North America is doing better or Europe, or is it across the board? And also a question on your hiring trend. Are you on track for 40,000 number headcount addition this year, or is it likely to change upwards or downwards?
Sure. Let me correct. I said realization this quarter has dipped, not gone up. And on pricing, we are seeing case by case, on a case to case basis, we are seeing pricing improvement, and that is across geographies. It's not limited to one specific geography. On hiring perspective, 40,000 remains, and we are on track for that.
And on margin front, what are the
Anisha, we're
levers
very
available?
tight on time.
Let's
Sure.
take this separately. Yeah. Anurag from Z Business.
Sir, going forward, do you think that there will be some change in demand from your key markets? Demand scenario will change from key markets.
You're saying the mix of demand across
Yeah,
markets?
yeah.
See, it's a bit of cyclicality. We were having very high demand from Europe and UK a couple of years back. Last year on last few quarters, we are seeing North America come up last year and starting about a year back. So that kind of variations will continue. But the primary markets being essentially North America and Europe and including UK, that I don't see much of a change happening. And that continues to be doing quite well, double digit, North America close to 20%. So we don't see much of a structural change in it, but between markets there could be variations.
And sir, in domestic front, this quarter, have you joined any government projects?
The public sector continues to be a focus area for us.
Yes,
No immediate call out projects that we want to. Last quarter, we had a very significant project win, which was the second phase of the Passport Seva project that we had called out last time. Compared to that, there is nothing of comparable size here. This is more regular project related work.
Ramata Mazumdar from Economic Times.
Hi, hello, good evening, gentlemen. First query would be for NGS specifically. You have mentioned, like, if you could give us some breakdown on clients or deal wins across the new business groups, that is enterprise growth and transformation groups specifically. And for Rajesh, I would want to understand, in the recent quarters, we have talked about how vendor consolidation will get TCS a lot of the new deals coming in, or even renewals that come in. So is there anything, from a deals perspective that you would like to call out in Q1 that would have come from some of these initiatives? And one other thing I would like to understand is, in terms of the deal pipeline itself, there is a conversation that Horizon 3 kind of deals could kind of see a slowdown given the kind of spending environment that we are looking at. What is the kind of discussion and feedback that you've had from clients?
Sure. I'll start.
See, overall, as Rajesh said, its growth has been broad-based. So across the three distinctive groups that we have outlined, the business transformation group, enterprise growth group, as well as the relationship incubation group. First, I want to say that the organization has been put in place, and it's so commendable to see that the whole organization rallied behind that structure, and they started to fire in all the three groups. We'll be shortly, probably moving forward, we'll be giving you more details about how we are performing in each one of these groups. But I'm pleased to say at this point in time that the business transformation group clocked 5.6% growth this quarter, and likewise the relationship incubation group also has fired in above 5% growth, and the enterprise growth group is also grew more than 17% year on year, right? So overall, I think it's important to note that these kind of organizational structures is once in a while it's important to see that, and then the whole customer curated journey that we are attempting to do has been quite well received internally as well as externally from our clients.
Coming to the nature of the deals, in fact, the two large deals that we spoke about, both are driven in large part by operational transformation which has vendor consolidation at the back end of it. So that is, that's playing out as we expected. There is more appetite for customers to look at more strategic vendors who can provide them a consolidated set of services which can accelerate their transformation journeys, and consolidating the vendor landscape is part and parcel of that approach. So both these deals actually are, the volume is driven in part by that also. So that's on the vendor consolidation side. What was your second part of the question? Yeah, that's logical, but the way to look at it is that even when you look at the actual volume distribution, Horizon 1 was still the primary volume driver, and then Horizon 2 and Horizon 3 were more, there is a great value aspect of it, but volumes were not very high. So the way those projects will play out will probably stretch out a bit more, but Horizon 1 continues to be significant. It's going through its own period where, as we have spoken in the past, workloads are still in the range of 25-30% in. The actual heavy lift for Horizon 1 is just about starting, where the more complicated estates need to move, the larger footprints need to move, and the early part of the what should I say, the excitement is over. Now the real heavy lift has to start off. So Horizon 1 will continue to be the near-term volume driver, with Horizon 2 and 3 coming in, not necessarily entirely sequentially, but the volume distribution will still be Horizon 1.
Thank you. We have Tom Easton next from The Economist.
Hi, I hesitate to take time from other people, but I was very struck by your comment on patents, which I didn't expect.
On?
Patents. On patents. And I was wondering, in this initiative, are there any patents that are truly significant and that will change TCS's positioning as a technology company going forward?
It's like asking which is our favorite child. So all of them are equally important to our researchers who have worked on it. But the way to think about it is, the patent portfolio and our approach to patent is not designed to unearth one single item that is likely to completely pivot it. It is not to say that that might not happen, and if it happens, we will probably know it in retrospect rather than going forward. We are not a pharma company trying to discover one killer molecule for a known problem, right? We are a much more broad-based research agenda across a very wide spectrum. So our approach to it is different than what you would see in other industries. We do try to consolidate these patents and incorporate that into many of our product solutions. Some of them could be game-changing and on their own right. But our approach to it is very different than a typical pharma or a technology kind of approach.
Thank you, Tom. Next question from Shivani Shinde from BS.
Hi, good evening, gentlemen. Congratulations. Rajesh, this one is for you. Now, typically, for IT services and TCS, the growth is generally front-ended. This particular quarter, we see a strong growth coming from quarter 3, quarter 4, quarter 1. Do we see any change in the fiscal going ahead? Will the growth remain front-ended with quarter 3, 4 being a little slow?
Shivani, very difficult to say, because please remember that last year came on top of a pandemic-affected year. So we are not yet into the stable one. So for the growth to get to a more normalized manner, probably we'll need to wait for a year more to be able to see what the patterns look like. Right now, there is demand and we are chasing it. What will happen in H2? There are many other moving parts that we will need to keep a close watch on to figure out. Very difficult to take a forward call on that.
NGS retail has really bounced back, big 20% and above. Do we see this being sustainable? Do you think the pain point in the retail CPG units are gone? Because what we hear from analysts, especially from the US economy, is if the recession, and there is a big recession, the retail is the sector which will see some pressure. What's your take on that?
I think if there is a recession, if there is a macro issue that's affecting that industry, I think it's reasonable to assume that that might get affected. But then the kind of wisdom that we are gaining from this whole industry is that they are investing heavily in technology, right? Almost if you really look at it, no matter who the retailer is, same day delivery is becoming a norm, right? And then the customer experience that they want to give is very, very differentiated, and it's a highly competitive market amongst all the retailers. In that context, that amount of technology that they are spending in the area of pricing, in the area of organizing the stores differently, organizing the logistics differently, reimagining the supply chain differently, investing in warehouse technologies and things like that is huge, right? So in that context, it's quite unlikely that they start something and then stop, right? I believe that most of them, at least the one which we have polled, they have said that look, these kind of technology interventions that we are trying to make is long term, very strategic for us, and it's unlikely that we will pull the plug no matter what happens. That's the kind of feedback that we are getting, but I can't say anything more than that, right? I'll put it this way.
A final one from me, 40,000 number, do we see that changing? Because 40,000, I mean, as someone said, you've spoiled us in terms of numbers, so looks a little softer. Do we see that changing over there in the next few quarters? Thanks.
We have always beaten those numbers, right? If I can only, if I go back in time and see what we have done, we've always beaten those numbers. So I think we are confident in terms of the capacity that we have and the order book that we have. And ultimately we'll have to execute it, and when we have to execute it, we need hiring, we'll have to hire. The good thing is last year also, initially we projected only 40,000. And then when we saw that the demand is picking up and this is all we have to do, we reached out and then we could hire record numbers, right? So the whole, the database that we have in terms of the national qualifier test and the people whom we have interviewed in the past, and our ability to nudge them in terms of saying that look, you did well in these areas, and if you can just clear this particular test of TCS, then you could straight away join at this level. These are all the technology interventions that we have from a HR perspective. So if we have kept it at 40,000, but if there is a demand uptake, our ability to hire from the market, our ability to attract the right talent is second to none.
Thank you. Next question from Vivek from Informist.
I'd like to know about your work from office strategy. So you have said that you are seeing steadily employees coming to office now. So going ahead, how much of an impact do you see this having on your margin front?
Margin front, work from office is not likely to have a very significant impact.
I mean, travel costs, yeah.
Yeah, travel costs is not so much related to work from office, it's more related to people going for client meetings, client discussions, and that has gone up this quarter also. It has doubled compared to the past period, and it's likely to keep going up as business travel increases. But work from office is not linked to that. Work from office, most of our facility expenses were more of a fixed nature. Some amount of electricity consumption, etc., will go up, but that will not be a very significant driver.
Thank you.
Debangana from Money Control.
Hi. So firstly, this is the first quarter that the restructuring plan has come in place. We have the new business group. You have already shared the growth numbers there. Wanted to get an outlook for the upcoming quarters, and how do you expect the growth to shape up there?
It's always a problem of sharing the number upfront, but we are very, as NGS mentioned, it has gone through very smoothly. The organization has come together. The transitions are almost complete. In fact, front-end transitions are all complete. Some of the back-end transitions are still ongoing. So overall, we are quite happy with the way that has progressed. And it has injected fresh energy into the teams. The whole approach to what we call curated customer journeys, that is resonating very strongly, both with our teams as well as with our customers. So all of that should give us a good buoyancy. But I don't want to get drawn into giving a specific number.
Sure.
I think the proof point of that will not just be on the revenue side, but we expect to see greater vibrancy on the bottom end of our client pyramid as we see the progression from the lower revenue bands to the upper revenue bands. So if there is one metric that will give a good sense of whether how good that is, would be that. But any new structure, you need to give it time for it to start, really delivering on the on those strategic drivers.
So the India business started declining last quarter. So has that started recovering? Any update there?
It continues to be very volatile. So it has got a combination. It's one of your colleagues asked about public sector. It's got public sector. It has got the India private sector, and then it has our small and medium business, the ION business. Very volatile across the period. The corporate sector is relatively doing well. We are also selective about what projects we are taking given the overall volatility in the market. So overall we are quite confident about India. Period to period volatility is in the nature of this market.
Right. Sir, also wanted to touch upon the return to work, hybrid work model. So I think 20% of the staff is back to office in Q1. So what is the update there? What's the plan going ahead? Since I think TCS has said that 75% will be working from home by 2025.
So we will, on the immediate basis, we'll continue to drive the return to office mode because as we have said, the 25 by 25 plan needs to be executed in a more controlled manner, and it needs to be, so the path to that will first involve getting back to a more normal working environment, and then getting to the permanent hybrid environment. So this 20% we will keep on, subject to of course anything else, but we will keep on driving the 20% back to our regular ones. Definitely well above the 50, 60, 70, 80 mark kind of as we go forward. We should see steady progress on it every month from now on.
Right. My last question, Samir sir. You mentioned that the margins would start improving going forward. So could you share the utilization percentage for the quarter? And also, how much headroom do you have really at the moment?
So we don't report the utilization percentages, but we have strategically invested into the growth. So we would be carrying some bench initially, and that's what Rajesh also called out. We would be looking towards that in terms of optimizing in the future also, but I can't give you a specific number on that.
Sure, thank you.
Embracing the hybrid world, we'll now get to the journalists who are virtual. So let's start with Harshita Sawant, who's joining in on video from CNBC Awaaz. Yeah, Harshita, you can unmute.
Thanks, Kritika, and good evening, gentlemen. I thought I'd get caught in rain, which is why I couldn't be there, but tough luck. Rajesh, you mentioned you would chase the demand where it is in the future. Could you give me an understanding of where is the demand likely to grow? It could be perhaps segment-wise. Which segments are you seeing larger demand coming through? Is it going to be BFSI or retail, which has shown you a very strong bounce back? And also, if you could throw some light on the attrition numbers, because you mentioned that this the attrition being on the higher side is likely to spill into Q2 as well. In that case, do subcontracting cost continue to remain higher, and would that is that likely to continue to put pressure on your margins going forward, Samir?
So on the demand side, as I said, we are cycling into North America being the primary growth driver after many years, and into the next year or next 3-4 quarters, we think that North America by far will be the strongest geography from a growth perspective. Within North America, the vertical industry mix is quite uniform. We are seeing very strong demand across all the verticals, whether it is BFSI, retail, manufacturing, some segments more than the others, but it has its own supply shocks, but otherwise the demand actually is quite strong, and so on into other. Even travel and hospitality has recovered very strongly. So we don't see a vertical dispersion in the growth rates. It's a more uniform kind of growth across market, but North America will be the primary market.
On the subcontractor cost question, Harshada, so we are we continue to stay focused on chasing the demand, and as far as that's there, our priority would be to capture the demand, and if that means if attrition levels do remain up, we will stay invested or continue to invest into it. We know how to optimize it, and when there's a requirement, we can optimize on the subcontractor cost levels.
Thank you. Next question from Ayushi Kar from the Hindu Business Line, who is joining us on audio. Ayushi, you can unmute yourself. Ayushi, if you can hear us, you can unmute yourself and ask your question. Okay, I think we have some audio issue. We'll go to Sethu Raman R, Reuters, who is also joining us on audio. Hi, Sethu. You can unmute yourself and ask your question. Okay, I think this is just the reality of the hybrid world as well. We have a question coming in from Ayushman from Mint, who couldn't join us. His question is on the metaverse. We haven't heard anything much on the metaverse from TCS. Could you please give us some color on your initiatives from the metaverse?
There's been quite a bit of reporting that we've done on the metaverse. So we are looking at it both as a proof of capability as well as a individual solution that we are rolling out. Current solutions are primarily on the retail side and some amount on the banking financial services side. So beyond that, it is, I would say, preliminary work, exploratory in nature, but definitely it is something that will happen. How fast and how what the uptake will be difficult for us to predict. Our approach is to stay engaged in it, and we have our labs working on it as well as our now increasingly our solution teams working on it. So with a telecom vendor, we have helped develop a e-commerce site, which is now more, what should I say, executed in that metaverse kind of domain, but still selling real products. It's not digital products being sold. We have experimentation going on in wealth management area, where the younger demographic is being experimented with in a more hipper environment. But these are all initial exploratory kind of projects, more as we feel out the space and both build capabilities as well as prove capabilities on both sides, us as well as clients.
Thank you. Shubhra Tandon from Financial Express is in a really bad network area, so she sent us her questions as well. To NGS, it is being said that hiring from smaller towns could help Indian IT companies gain back some of the cost advantage that got lost to some of the other cheaper markets. Is that the approach?
We always had a very good presence in terms of tier 2 locations, whether it is Indore, Lucknow, Gandhinagar, Guwahati. So we have a series of places where we have development centers. And the other thing is that, look, when you really look at our national qualifier test, it's basically we have democratized it. So we have seen candidates appearing from all parts of India, and we have been able to hire people from all parts of India. As a moving forward strategy, I think we reviewed it. We believe that we have enough capacity on the ground in tier 2 locations, and that's something that we will constantly review and then take a call.
One more question on pricing. Her question is, I would like to know your comments on pricing, because companies have secured some revision, though not enough to offset wage inflation. Also, what is the outlook going forward on pricing, at least for this year?
Similar to what I covered, Kritika. So pricing, we are seeing case-to-case improvisation, and we continue to stay focused on getting pricing as well as realization improvements.
Thank you. We have Laltendu Mishra from the Hindu, who's joining in now on audio. Hi, Laltendu, you can take your question.
Hi, good evening. Can you hear me?
Yes, we can hear you.
This question is to Rajesh. Was there any impact of the Russian war on the business of the company in the last quarter, and what is the outlook?
No direct impact. As we have clarified in the past, we don't have direct operations in Russia, no employees, no customers. So direct impact is not there. Of course, there is an indirect impact through the stress that the European economy is primarily feeling from it, and the larger one in terms of what the war does to inflation and supply chains. So second order, third order impacts, but which are very difficult to quantify. No first order impact because we don't have a footprint either in Ukraine or in Russia or any of the war affected areas. However, we stay focused on helping both our associates with who are interested in contributing to the humanitarian effort. We have shared in the past, we have made direct contributions to the tune of about €1 million. We have made matching contributions along with our associates, all towards NGOs who are helping relieve the human tragedy that this war is causing in large population.
Thank you. Final question from Joshelle, who is under the weather. Net addition is the lowest since Q2 FY21. How do we look at this hiring in terms of growth expectations going forward? Whoever can take that.
Hiring is?
Lowest since Q2 FY21. How do we look at hiring in terms of growth expectations going forward?
I think we addressed that earlier in the session. As I said, it has to be seen in terms of the total hiring that we have done. Last year, I think we hired on a net basis slightly more than 100,000, which is more than 20% growth on our headcount, on a revenue growth of about 15%. So we have fairly significant capacity that we have built up. And this period to period variations will happen. Q1 is primarily driven by the seasonality in the trainee hiring. And beyond that, we will remain tactically vigilant in terms of tracking where the demand is, but we currently have the capacity and the headroom available to service the demand that we see.
Thank you. Thank you, gentlemen. Big thanks to everyone over here who's joined us, and huge thanks to everyone that's joined on YouTube across all our social platforms. Have a great Friday evening and a good weekend. Goodbye.